in reality, our 1.3 million is invested, right? We got this 1.3 million over here. And the actual portfolio that we're trying to withdraw 4% plus principal off of, it's going to do this over time. And the evidence of that is that I could go back to the financial analysis room. I could go back, there you go, and I could go to third party, and I could go to the large company stocks slide here and just show the volatility, right? This doesn't show dividends, it just shows price movement. Just look at the volatility for your basic diversified large cap equity portfolio, right? These are like your safer stocks. Some of these are your blue chip stocks. There's no small cap in here. There's no international in here. This is all large cap domestic. How frequently, on average, does a down market occur? How frequently, on average, do you have a negative return in your large cap stock portfolio? Somebody, what, like? 4 and 5 years. At least once every 5 years on average, somewhere in the 4 range, maybe as frequently as 3, maybe we'd go as long as 5, right? So we know that there's going to be some bear markets during retirement. We know that's going to happen. How do we protect ourselves against the situation a lot of people have faced at various points in time, the wrong points in time, where they decided that they're going to start pulling either interest only or principal and interest off of a portfolio in a year when they have a big dip? Or in a year where they have a big dip that's followed by another big dip, that person really runs a huge risk of running out of money. Right? We've all seen that sequence of returns conversation. We do it in the basic schools. We do it in protection and strategy schools. We've done it in LBS using the calculators. That is something we can't control. So we have to have a way to engineer that risk out of this plan. And it's a very simple thing to do, right? Promise you, the guy at Merrill Lynch or Morgan Stanley or wherever that other investment bureau is, they don't have this conversation with their clients. So we're gonna describe something here that is called a waterfall distribution. We sometimes talk about this in terms of curing an illness called paycheck syndrome. And the paycheck syndrome is that people have been used to getting a paycheck in their bank account or their mailbox every pay period, right, for their entire working years, maybe 40 or 50 years. That money was guaranteed to be there as long as they were employed or as long as they did their job well. And all of a sudden now they don't have a paycheck anymore, and they're reliant on market opinion to deliver their income. And that makes them feel ill. Right, it makes them feel worried, anxious, and they have anxiety. Tripp always talks about how his grandmother watches the financial news every day, and she's like 90 years old. She's so worried about what's happening in the market with interest rates because of the way that people have traditionally retired.
Do you want to tell them that they're out of control of the situation?
They're totally out of control of the situation. They have no control over what the market does or interest rates. So how do we engineer that out of the portfolio? We're gonna start to build something here that might sound a little crazy to them at first. Here's what I want you to do with your first year's worth of income, right? You're going to go out and get a special type of an account at a local bank, or we could even open one up here. It's called a checking account, right? The interest rate that we expect you to get on this checking account is 0%, and you're going to put $74,000 in it. So what will your return be at the end of year 1? Zero, right? Just making sure we're all clear on exactly what this does. So this is a checking account for year 1. Now, what we're going to do for the subsequent years is we're going to create a shock absorber for their income in the market. We're going to create what I described earlier, the firewall between income and volatility. We're going to do that by creating what I call corridor accounts. Corridor. There's some syllables in there. Sometimes missing. And what I am trying to visually represent here is that we are going to, in each of these accounts, we're going to put an amount, a present value amount in there that with interest we know will equal 74 net of what we need to have, or even more in some cases, of what we need to have every single year for income for some period of time. Right? So I'm going to go out and I'm going to use 2 types of tools. This part here is either going to be bonds, they're going to be smaller, and I'll explain why. You'll see why, right? These are either going to be bonds or CDs. The reason, and they're going to be individual bonds or CDs, and the reason is that I need to know that the principal and interest will be returned with some guarantees, basically, right, that they'll be there. A bond fund doesn't work because a bond fund has volatility. These accounts can experience zero volatility. I just need them to mature when they mature and have the money be there. And I'm going to go out and I'm going to use a simple tool like the present value calculator in LBS here. I'm going to say if the future value I need is 3%, then at the end of year one, if I want $74,000, then today at say a 3% discount rate, maybe that's what I get on a one-year bond. I'm just going to use 3% today because it's easy. I need about $72,000, right? And I can run this out. I can click ahead here and see. For the year 2 bucket, I need $72,000. For year 3, I need about 70, 68, 65, 63, 64, and so on, right? So I can just simply do that, and I know I'm going to go to the bank, I'm going to go to our brokerage account, and I'm going to call up the trader, and I'm going to say, this is the amount I need in my 2-year bond or CD, my 3-year bond or CD, my 4-year bond or CD, and I'm going to build out this shock absorber. So it will look like this. I'm going to get my numbers out here because I've already calculated them all. I thought I had.
We want to put the bonds on here. We have 4 years there.
We have 4 years. Oh, there it is right there, right in front of me. Okay, so 74, 72, remember at 3%, 70, 67, and 65. And, we're rounding here, but these are pretty darn close. And every year, right, as these bonds, so this is a 1-year, a 2-year, a 3-year, and a 4-year, a bond or CD, at whatever the prevailing rates are. Every year they mature, that money rolls over and it performs the job of the next year's bucket. And what I've got backing all this up is basically what they call a bond ladder, right, or a CD ladder. It's used very differently than the typical ladder approach is used because this is paired with the vast majority of the assets in a return-focused bucket. So when someone says, oh, a bond ladder, we do that. This is not a bond ladder, right? This is like when people structure CDs and bonds in a laddered way, they're just trying to spread the risk around for their bonds. They're not trying to do a distribution approach to withdrawing income without experiencing volatility or being subject to volatility in the market. So we've got about $952,000 left that I can allocate with a return-focused allocation. I can go and put it in the 60-40 or the 70-40 portfolio, 70-30, excuse me. 70-40 would be better. I can have it be return-focused. I can actually afford to take some risk because I know that I'm 5 years away in that portfolio. I'm 5 years away from being forced to take a withdrawal for income. And even then, as I'll describe in a second, I don't necessarily have to do that either. So if my portfolio is up, if I have a year like 2013, what did the S&P do in 2013? About 30+%, right? So I've got a diversified portfolio. Maybe I did 25. I can take some money off. I can take just enough off to fill up the 4-year bucket again. How much do I need to take off? 65-ish. Depends on what the rates are for that bucket, but it's not a lot of money that I have to withdraw, and I can let the rest of it stay in there and be just return focused. So in a year like that, I would say, all right, great, let's fill up the 4th bucket, and let's just keep going, right? Leave the money. Now I've got maybe $1 million in that account, more than I started with overall, and it gets to say return focused. I'm not worried about what the market's going to do because I know my income is there in the checking account, and I'm just payroll deducting it, or I'm just automatic drafting it into my actual operating account every month. What if in the return focused bucket I have a year like a year where I have a 10% drop in the overall portfolio? It's down. What do I do? Nothing, right? I do nothing. I do what you're supposed to do, which is not make an emotional decision, and I don't have to make an emotional decision because I've got the next 4 years of income after this one already lined up and in place. So in a year where I have a down portfolio, I make no withdrawal, and I just wait, right? And I wait, and I wait, and I wait until I have positive return, until I get back over my high water mark, and I can take gains off the portfolio again instead of having to take a loss. So maybe I wait 3, maybe even 4 years. Eventually, I will have a gain, right? Bear markets, typically, the longest that's ever lasted is like 3 years. I think it's actually 2.5, right? So if I've got 5 years, I've got a long time to wait it out. And when that finally happens, when I have those gains on the portfolio again, I can fill up all the buckets all at once. What if I have a market worse than the one we just went through? Because the one we just went through would still work in this kind of an approach, right? Like the market we just went through would be absorbed by this structure. And it's the worst market, the worst drop that we've had in a very long time. What if I really needed to wait 6 years instead of 5? What could I do for the first 20 years of retirement without having to sell shares while I'm down out of my return focus bucket? I could do a ladder of 6 years, but that's kind of inefficient because the 6-year risk is not a big risk. Right? I don't want to do that. I don't want to do that if I don't have to. What else could I do? Beautiful. Cash, value, and the whole life policy, Lee. So I can go back because I have, as Frances pointed out, right, her big word earlier was, what about liquidity? I've got a superior source of liquidity right here in the whole life cash value that can stretch me out 6, 7 years if I need to. So I don't have to ever go and have this horribly inefficient portfolio that is all CDs and bonds and cash for all my money in retirement. I can structure a highly low-risk portfolio that for certain elements still gets to be focused on a return. When I say low risk, I mean low risk to my income. And the assets are at risk, but that's part of the deal. But I've built some guardrails around that risk so that risk never bleeds over into my lifestyle. Does that make sense? So that structure here, if you want to, I think of it almost visually like this, right? It's corridor accounts and the big non-qualified. That's all built into this non-qualified bucket. Whether you're doing interest only or you're doing a pay down like the one we're describing here, you have to have a systematic way to withdraw money from those investments without running the risk of a poor sequence of returns. And that's something that we can engineer really so easily at the end of the day into their world. If it's a small account or a small like asset-based income type client you're working with, and it's just not feasible for you to go and manage those corridor buckets and go and get on the phone and buy bonds, with the trading desk, send them to the bank. Let them go get CDs. They can structure this pretty easily on their own, and all it is a review once a year to decide what are we going to do. Do we fill the bucket or not fill the bucket? A lot of clients can actually, once they get this, they can manage it themselves. Right? The power of this to me is obviously it's powerful from a risk and income standpoint. Nobody else is putting all this together from a distribution planning standpoint. We really separate ourselves with this kind of a story. I mean, I've had people that they collected the data for us on this story alone in the open, just because in about 5 minutes we taught them something pretty powerful that they didn't already know. And they thought, well, maybe it would be worth my time to see what else these guys know, right? So again, you're just trying to cut through the BS, the noise that's out there in the marketplace, and let people know that we know investments better than the investment specialists. We know insurance better than the insurance specialists because we know how to put it all together, right? Not about just knowing one player. It's about knowing how to coach the whole team, and that's really what we provide. Okay, thinking about summarizing things here, does anybody have questions? Yes.
Yeah, you just said something that triggered a thought.
At least that happened one time for me today. Right?
So you would use what part of this in the open? You can't go through all this.
I don't go through all this. What?
You said, I said.
Here's an example. Yeah, here's how this comes up in the open, Bob, and how that story comes. So we're talking about things in the open, and we talk in conceptual terms because we got to start big picture and work our way down. And sometimes people will challenge you. So here's where it came up, or it does come up for me in the open. What makes you different than everybody else? And I'm saying, well, let me answer that question for you, right? He's asking the question, what makes me different? Well, I'm talking about accumulation that everybody's focused on. And it's important, but what's more important is what happens at distribution. And we are distribution planning specialists. Like, we know how to take assets and structure them in just the right way to create streams of income that, blah, 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 the whole story. And they say, what do you mean distribution planning? Can you give me an example of what you guys would do differently than the Merrill Lynch person or my guy from a distribution planning standpoint? So to me, that's like the easiest 4-minute story I could tell around distribution planning that I've never had it fail where they're like, huh, that makes perfect sense. I've never thought about that. I've always wondered how people deal with that. I find that you could tell that story to a room of Merrill Lynch guys, and they would have the same reaction. That's how I know that it's just a powerful differentiator, right? So I'm only using it selectively, Bob, when they are kind of have their arms crossed and they're saying, show me something. What I could do is I could go down the road of doing a spin down, and I've done that before, but I've just focused on spinning down the non-qualified. It's just not the right time to get into the life insurance yet. Too soon, right? It's way too soon. It's like asking someone to marry you on the very first date. It's too soon, right? Chris, how long did you wait? How many years? 4.5 years. That's an appropriate amount of time. Chris, congratulations to Chris and Charlotte. Got engaged this week.
All right.
Beautiful, Chris. And he waited the appropriate amount of time, right? She might have had a different answer if he said it the first day that they met. So that's why I'm not getting into whole life on the first day, because even though I think that we could be great together, right? She may never see it.
Specifically, Dan, are you using a desert island? Is that what you're going to use? Or
no. I think again the desert island story, the whole life, all that is for a later meeting. Because I don't even know that that's going to be part of our conversation yet, right? So this one is so easy and it's so generic. Yeah, they don't have to put numbers on it, right? And they get it. It's a good story to tell. This is something that we do as a firm very, very well. What else? What other questions?
So what product got implemented?
Yeah. So let's talk about what got implemented here.
I thought you went through the 360,000. Or down under policy, or
yeah. So we manage. Let's just say what we would do in this case, right? Manage 1 point, certainly like the non-qualified. The qualified in this case is at a 401k at work, so we couldn't really manage that. But we're going to do the annuity down the road, right? So there's an annuity to be placed. If a bunch of that qualified money had been in an IRA, where we could have moved it over, then we would have managed that as well. Maybe that would go in a managed account to grow until we use a SPIA one day, or maybe we would go ahead and put it into like a Target 200 so that it could double, right, over the next however many years. And they continue to fund their current 401k at whatever the clip is to get the match, but that's going to be a small amount of money. So we've got the annuity or assets under management for the qualified. We're managing, 600,000 minus 350, but we're managing all of it, right? We're just taking 20 out a year to pay for the whole life. So we're managing 600 grand growing to 1.3, and we got a $20,000 a year whole life policy that we implemented as well. And the secret to doing that kind of business is to do all of the business, right? Like it's amazing how much easier it is when you are conversant in all those areas, when you're actually licensed to do all those things, where you have the resources with you on the team to do all those things. It's a lot easier to sell a $20,000 premium when you're managing their investments. It's a lot easier to manage their investments when you sold them a $20,000 premium, right? So it's one of those things. Is it the chicken or the egg? I don't know. We don't have to know because we're presenting the whole plan to them. And it's more like, well, okay, you got all these products on a shelf. What's the best mix for me? This is what we think you should do. And now the decision is, do I work with you or not work with you? The decision is more along the lines of, hopefully, what does that mix look like? What do we feel comfortable with? Okay. Last thing I'll say, and we'll take any other questions. I know we just hit our time limit here. Part of what this story addresses is this truism, and Tom Hagman talked about this. You think about what's the riskiest time in the market for someone during their life. 5 years before or after retirement, right? So what we're basically doing is, with this structure, we are delaying that 5 years so that it never comes, right? You think about, like Tom had this slide that he drew out. I'm going to draw this up here in the corner, small scale. He drew out the accumulation of wealth, and then we started to distribute the wealth, and he said, here's this window, right? 5 years before and after that day you pull the trigger and retire, that's the riskiest time for anybody in the market. And what we have done with this waterfall distribution approach is we've basically pushed off the retirement forever. We've pushed off that risk point forever. So they're always 5+ years away. They never have to experience that risk, hopefully, in their portfolio as it relates to their income. Maybe their asset base, but not their income. And, I think that's a pretty powerful story to show someone that they can not have to have that worry that everybody that they know in the world who retires with their 401k has that worry. We've taken it off the table for them. Any other questions before we wrap it up? All right, thanks everybody. Have a great week. Don't you love it, Lee? It's just so much fun.